Welcome to the Financial Flow. Please like and subscribe to our channel and turn on notifications to stay up on our latest videos. With inflation nearing its 40-year high, the Federal Reserve is expected to raise interest rates several times in 2022. Jerome Powell, chairman of the Federal Reserve, stated what will be required to ensure a long economic expansion. That's going to require the Fed to tighten interest rate policy and do our part in getting inflation back down to our 2% goal. The central bank accomplishes this by changing the federal funds rate, which is its primary tool for managing the economy. Specifically speaking, the rate was reduced to nearly 0% in 2020 to stimulate the economy at the start of the pandemic. There is an important job for us to move away from these very highly stimulative monetary policy settings, Jerome Powell stated once more. Changes in the federal funds rate affect a variety of borrowing costs, from the amount you owe on your credit card to mortgage rates. They also influence larger business decisions, such as how many employees to hire or whether to raise prices. Here's how the federal fund rate works, and how a single rate can influence the entire economy. So, the Fed meets every 6 weeks or so, and they look at a variety of economic data during those meetings, but they have two main goals. One goal is to keep prices stable and inflation low. The other is to ensure that the labor market is robust. Consider the economy to be a car, with the Fed as the driver. They want to make sure the economy isn't growing too slowly, and when it is, they will step on the gas, but they will also monitor the speed. As a result, they'll slow the economy by squeezing the brakes. This is where the federal funds rate enters the picture. When you hear about the Fed raising or lowering interest rates, it's because they've decided to raise or lower the federal funds rate. This is the rate at which banks charge each other to borrow money overnight. But there's a catch. The Federal Reserve does not directly set the federal funds rate. So, in order to influence it, the Fed employs a number of other tools to establish a target range. These are the rates that the Fed control as a bank for banks. Here is the target range that was in effect in 2021. The Federal Reserve establishes an upper and lower limit with the goal of keeping the effective federal funds rate somewhere in the middle. Interest on reserve balances determines the upper limit. This is the interest rate a bank receives on deposits, known as reserves, held at the Federal Reserve. Overnight reverse repurchases determine the lower limit. These are securities similar to treasury bills, but the Federal Reserve lends to banks for a day and pays interest, which is the effective federal funds rate set by banks, sits between the upper and lower limits. As the target range changes, the effective rate goes up or down with it. So far, they've had a lot of success in guiding the federal funds rate and all short-term money market rates to where they want them to go. The Fed makes these changes in relatively small increments. Its rate hikes for 2022 are expected to be only a quarter to half a point at a time. So how can these minor changes for banks help to cool down the entire economy? It's all about how those rates ripple through the system. Banks will charge their customers more as interest rates rise, affecting the cost of existing loans and demand for new borrowing. The purpose of raising these rates is to reduce demand. Inflation occurs when supply and demand are out of balance. The Fed has no power to increase the supply of oil or the number of houses for sale. The supply side is out of their reach, but they can bring supply and demand together by lowering demand. Here's how interest rates can affect demand and inflation. When interest rates are low, more people in business are likely to borrow. Higher demand for goods and services, combined with lower rates, allows employers to fill more positions and raise wages to attract potential employees. Consumers then spend their earnings on goods and services, which can lead to more jobs and higher prices. When interest rates rise, the opposite occurs. Loans are being taken out by fewer people and businesses. Job growth is slowing and spending is decreasing. Higher interest rates may also make saving more appealing. As supply and demand balance, inflation slows. While interest rates can be effective in lowering inflation, a rate increase may take some time to take effect. Consider your own life as you make decisions about whether or not to buy a house and how big a house to buy. It may take some time for this to spread through the housing market, but if interest rates are high enough to slow interested consumers, we could see less demand in 6 or 12 months. While inflation may take time to subside, higher interest rates on loans, mortgages, and credit cards are likely to have an immediate impact on consumers and businesses. Thanks for watching. Don't forget to leave a like and subscribe to our channel for more content like this. Have a good one.